A business loan is a financial tool that helps entrepreneurs and companies obtain funding to start, operate, or expand a business. Whether a business is newly established or already growing, additional capital may be needed to purchase equipment, hire employees, manage daily operations, increase inventory, or invest in new opportunities. A business loan provides access to these funds with the agreement that the borrower will repay the amount over time according to the lender's terms. A business loan is an agreement between a business owner and a financial institution. The lender provides a specific amount of money, known as the principal, while the borrower agrees to repay the principal along with interest through scheduled payments. The repayment period, interest rate, and loan conditions vary depending on the type of loan, the financial institution, and the applicant's business profile. Businesses apply for loans for many different reasons. A startup may need funding to launch operations, while an existing company may require additional capital to purchase machinery, expand production, renovate facilities, introduce new products, or improve cash flow. Some businesses also use loans to purchase commercial property or finance large business projects. There are several common types of business loans. A term loan provides a fixed amount of money that is repaid over a specific period. A working capital loan helps businesses cover everyday operating expenses such as payroll, rent, utilities, and inventory. An equipment loan is designed to finance machinery, vehicles, or specialized business equipment. Some financial institutions also offer commercial property loans, business lines of credit, and small business loans for different financial needs. Business loans may be secured or unsecured. A secured loan requires collateral, such as commercial property, equipment, or other valuable business assets. If the borrower cannot meet the repayment terms, the lender may have legal rights regarding the collateral according to the loan agreement and local regulations. An unsecured loan does not require collateral but may have stricter eligibility requirements and different interest rates because it presents greater financial risk to the lender. Before approving a loan, banks and financial institutions carefully evaluate the applicant's financial condition. They may review the company's business plan, revenue, operating expenses, cash flow, existing debts, financial statements, and repayment ability. The lender's goal is to determine whether the business is likely to repay the loan according to the agreed schedule. Many lenders also consider the business owner's credit history and, where applicable, the company's credit profile. A strong credit history and responsible financial management may improve the likelihood of loan approval and may qualify the applicant for more favorable lending terms. Applicants are usually asked to provide supporting documents such as business registration certificates, tax records, financial statements, bank statements, business licenses, proof of identity, and other documents required by the lending institution. Depending on the loan type, lenders may request additional information before making a final decision. One important financial concept is the interest rate, which represents the cost of borrowing money. Some loans have fixed interest rates that remain the same throughout the repayment period, while others have variable rates that may change according to market conditions. Understanding how interest affects total repayment helps business owners plan their finances more effectively. Before applying for any business loan, entrepreneurs should carefully estimate how much funding is actually needed. Borrowing significantly more than necessary may increase repayment costs, while borrowing too little may limit business growth. Preparing a realistic financial plan and repayment strategy helps businesses manage debt responsibly. A business loan can support growth, improve productivity, and create new opportunities when used wisely. However, every borrowing decision should be based on careful financial planning, realistic income projections, and a clear understanding of the loan agreement. In Part 2, we will discuss business loan repayment, cash flow management, common borrowing mistakes, business credit, loan default, financial planning, and practical tips for responsible business financing. Educational disclaimer: this video is intended for educational purposes only and does not constitute financial, legal, tax, or investment advice. Business loan products, eligibility requirements, interest rates, and regulations vary by country and financial institution. Always consult your lender or a qualified financial advisor before making borrowing decisions.
Receiving a business loan is only the first step. The long-term success of borrowing depends on how responsibly the funds are managed and how consistently the loan is repaid. A well-planned repayment strategy helps protect the business, maintain a positive financial reputation, and improve opportunities for future financing. Most business loans are repaid through scheduled monthly or quarterly installments. Each payment usually includes a portion of the principal and the interest charged by the lender. Paying installments on time helps avoid late fees, additional interest, and unnecessary financial pressure. One of the most important factors in successful loan management is cash flow. Cash flow refers to the movement of money into and out of a business. Even a profitable business can face financial difficulties if cash is not available when loan payments are due. Business owners should regularly monitor income, operating expenses, supplier payments, employee salaries, taxes, and loan obligations to maintain healthy cash flow. Keeping accurate financial records is equally important. Regular bookkeeping, income statements, balance sheets, and cash flow reports provide a clear picture of business performance. These records also help lenders evaluate the business if additional financing is needed in the future. Business owners should avoid using loan funds for unnecessary personal spending. A business loan should be used only for its intended business purpose, such as purchasing equipment, expanding operations, increasing inventory, improving technology, or supporting working capital. Responsible use of borrowed funds increases the likelihood of business growth and successful repayment. Many lenders also evaluate a company's business credit profile. Paying suppliers, lenders, and financial obligations on time helps build a positive credit history. A strong business credit record may improve eligibility for larger loans or more favorable financing terms in the future. Before taking additional loans, businesses should carefully evaluate their existing debt. Borrowing more than the company can comfortably repay may create financial strain and increase the risk of default. A realistic repayment plan should always match the business's expected income and future financial goals. Unexpected events such as economic downturns, natural disasters, market changes, or declining sales can affect a company's ability to repay a loan. For this reason, many financial experts recommend maintaining an emergency cash reserve to help manage temporary financial challenges without interrupting business operations. If repayment difficulties arise, business owners should communicate with their lender as early as possible. Depending on individual circumstances and lender policies, financial institutions may discuss available options. Ignoring financial problems often makes the situation more difficult to resolve. Fraud prevention is another important aspect of business financing. Entrepreneurs should work only with licensed banks or regulated financial institutions, carefully review all loan documents, and protect confidential financial information. They should never share passwords, security codes, or sensitive banking details with unauthorized individuals. When comparing business loan offers, owners should consider more than just the interest rate. Processing fees, repayment flexibility, collateral requirements, administrative charges, and total borrowing costs all influence the overall value of the loan. Reading the complete agreement helps avoid unexpected financial obligations. A successful business loan is not measured simply by receiving approval. Success comes from using the funds wisely, increasing business productivity, generating sustainable income, and repaying the loan according to the agreed schedule. Responsible borrowing strengthens financial stability and supports long-term business growth. Business owners should also continue improving their financial knowledge. Understanding budgeting, taxation, financial planning, risk management, and investment strategies helps create stronger and more resilient businesses. Careful planning and informed decision-making reduce unnecessary financial risks while supporting future expansion. Thank you for watching this educational series on business loans. We discussed how business loans work, eligibility, loan types, repayment strategies, cash flow management, business credit, and responsible borrowing. We hope this information helps entrepreneurs make informed financial decisions and build stronger businesses. *** educational disclaimer. *** This video is intended for educational purposes only and should not be considered financial, legal, tax, or investment advice. Loan terms, regulations, and lending practices vary by country and financial institution. Always consult your bank or a